Hi class. In this video I'm going to review a couple of the problems from chapter 4 in the textbook. So in this first one we're looking at some transactions, and in this chapter we're learning how to do journal entries and then posting into the general ledger. So this problem says the following transactions took place at the Cook Employment Agency during November, and we've got 3 different transactions, and the instructions tell us to prepare journal entries for those transactions. So if we come down here to the journal entry worksheet, it says perform services for job search for $37,000, and they receive $17,500 in cash, and then the client owes them the balance of that, and they're going to pay in 60 days. So in most of the journal entries that you've done up to this point in the homework, there have been 2 accounts that have been affected. For example, perform services for cash. That would be some kind of fees income account or some sort of revenue account. And then, of course, if you received cash, then cash would be affected. So up until this point, I believe all of the journal entries just had 2 accounts that were affected. In this problem, we have what we call compound entries because we have more than 2 accounts that are affected. So when we do our journal entry, we're going to have at least 3 accounts that we're going to have to adjust. So if we look at these instructions, there's some things that we know. We know we received cash, so one of those accounts that's affected is cash. We know that the client owes us some money, so we're going to receive that money at some point in the future. So if we have an account that we're going to receive payment on in the future, that's an accounts receivable. And then anytime we perform services, that's a revenue account. So those are the 3 accounts that are affected. So we're actually receiving cash, so that's a debit. Accounts receivable is an asset account, so to increase an asset account, we're going to debit it as well. And then we've probably got, they usually call the fees income as their revenue account. So that's going to be the credit. Now, the debits and the credits in a compound entry also have to balance. So if you have $1,000 worth of debits, you have to have $1,000 worth of credit, for example. Fees income is a revenue account, so revenues increase by crediting it. So it says they perform services that were worth $37,000. So that's the amount that we're going to show in that revenue. That's the actual amount that was earned. It says they received $17,500 in cash. So that goes in the cash account. And it doesn't really tell us how much they were going to get paid later, but we can deduce that. If they did services that were worth $37,000 and they received payment on $17,000, we can just take the difference in that, and we know that the client still owes them $19,500. And you'll notice that if you were to add these 2 together, it should total $37,000. If I did my math correctly, let's see. So yours should look something like that. So let's look at the next one. Purchased a graphing calculator for $410 and supplies for $560, and they issued a check for the total. Oh, and there was something I meant to tell you in the first one. When you're doing your journal entries, pay attention to this red note up here. Enter your debits first and then your credits. So we should have both of our debits and then our credit. So number 2 says purchased a graphing calculator and some supplies. Those are both assets, so the assets are debited to increase. So we've probably got some office supplies. If I can find it. Well, maybe not. Maybe it's just supplies. There it is. All right, so we got that supplies for $560. This problem's a little bit different because that calculator is in there and it's $410. So this is odd, but they call that calculator is actually classified as an office equipment. So office equipment is, I think it's an office equipment, or maybe it's just equipment. Let's see. That's an asset, so it gets debited, and then we issued a check, so we paid cash. Cash and checks, the same thing. As far as accounting goes. So that it means we're paying out cash, so we've got a credit. So we're going to have to add those 2 up to get the total amount of cash we paid out. So that's $970 in cash. And let's make sure I did that right. That looks good. So we're going to go back to journal entry number 3. And it says we received an invoice for repairs to the automobile. We paid half of it. We're going to pay the rest of it later. So we got some kind of expense there. Repairs expense, automobile expense. Just depends on how the problem's set up. Sometimes you have to look through those titles and pick out one. So I would say that sounds like an automobile expense. We know we paid cash for part of it, and the rest of it we're going to pay later. So when you're going to pay a bill later, you have an account that you're going to pay later. That's an accounts payable, and that's a liability. It's a debt that the company owes. So the expense was $1,950, and it says they paid half of that, so we're going to take that and divide it by 2. It's $975 that we paid out in cash, and the cash is an asset, so to decrease our cash, because we paid some out, we're going to credit that account. And then accounts payable is a liability account. So to increase that liability, in other words, we're going to increase the amount we owe by $975. That goes in the credit. So once you get all 3 of those done, they should look something like this. And your numbers, of course, will be different, but you'll go through the same process. Your accounts, I believe, should be the same. So let's look at another one. And we're not going to work through this entire problem, but I did want to kind of show you what process to use so that you could know how to tackle it. So this one says, on October 1st, 2019, Helen Kennedy opened an advertising agency. We have a whole list of transactions, and it says step 1, we're going to journalize the transaction. Step 2, we're going to post those transactions to the ledger account. And then we have an analyze question. All right, so let's look at a couple of them. The first one says Helen Kennedy invested $52,000 in cash in the business. So the 2 accounts that would be affected in that is cash. Cash is going into the business, and Helen Kennedy now owns capital in that business. $52,000. So we've got, put our debits first. The company gets cash, and she gets capital. And my debits equal my credits. We're in balance. So we're going to go to the next one. Paid October office rent of $2,600. So that's an expense. Anytime you pay something, unless you're buying some kind of asset, it's probably going to be an expense. So, whoops. That was rent. And since she's paying it for this 1 month, it would not be prepaid rent because she's not paying it way ahead. She's simply paying it at this point, just for this month. And she's paying cash. And it was $2,600. Whoops. All right, my debits equal my credits, so there's the 2 accounts that are affected. So let's look at 3. Purchased desk and other office furniture, $14,200. And we didn't actually pay it. We're going to pay it in 60 days. So we purchased office furniture. I didn't see a furniture. Let's see. They must just be calling that office equipment. So like I said, sometimes you have to pick through the accounts and find the one that sounds most likely. We're going to pay that later. And so we have an account that's payable at a later date, and it's $14,200. This one's $14,200. And that's all there is to entry 3. So let's look at those 3 and make sure I have them all in there correctly before we go on. So you're going to, and they are. So you're going to go through that process for all of those transactions. That's step 1, or requirement 1. So then after you get all of those done, you can move on to requirement 2. It says post the transactions to the ledger accounts, and those are in the 2nd tab. So let's look at the first one. It says we have cash and Helen Kennedy capital. So you're going to start at the top of your general journal and just work down one line at a time. So cash has a debit of $52,000. So we're going to go to the ledger account. And that was on October the 1st. We debited it $52,000. And you'll notice that it keeps a running balance. So this kind of looks like our T account. If you see right here, you could imagine a T with a debit side and a credit side. Our account name is cash. The difference between this and the T account, we have a spot for the dates, and this one keeps a running balance. You're not going to add down the totals. It's just going to keep a running balance for you. So we've posted that first entry. Helen Kennedy Capital was the next one, so we're going to go over here and find Helen Kennedy Capital. And this is the sad part about this. You have to do lots of scrolling in these kind of problems. So that one was a credit. Because it was a credit in the journal, it's got to be a credit in the ledger. Then just keep going down. So rent expense has a debit of $2,600. Whoops, and I didn't get the date. October 2nd. And I think that was cash. Yes, cash, $2,600. And that was a credit, so it's going to go over here, and you'll see that this automatically knows that a credit is subtracted from cash. And the third one was on October the 5th, and that was office equipment and accounts payable. And so you would do that, finish out all the transactions, post all of them over here, and at that point you'll have everything transferred from the journal to the ledger, and just work down, like I said, one line at a time. One thing to note, the balance, whoops, I got that in the wrong place, that's why it looked funny. The balance in this has it says it's a positive, and that's because accounts payable is a liability. It normally has a credit balance, but there's only one balance column, and it doesn't tell you whether the balance is debit or credit. So you can assume that the balance is whatever that account normally has as a balance, either a debit or credit. So liabilities normally have a credit balance, so this balance is a credit. Office equipment is an asset, normally has a debit balance, so that balance is a debit. When I actually had it in the wrong column before, and you'll see that shows up as a negative. That means the balance is abnormal. It's the opposite of what it normally would be. Accounts payable normally has a credit balance, and I have a debit here. That would, if we were to look at that in a liability account with a minus balance, that would really mean that we had overpaid those people back what we owed by $14,200. So we paid them too much. That's why that's got that minus there. So let's get rid of that, put that back where it's supposed to be. So you're going to go through that process for every one of the lines in your general journal. And so that's requirement 2. And then the analyze says, what is the balance of account 202? So to know that, you're going to look over here in the ledger and find account 202, and that's your accounts payable. Right now it's $14,200, but it could be that we have added to that or subtracted to that over the month, so it's probably going to change, but it would be the ending balance in the accounts payable. So that's really the process that you're going to have to go through for number 7. I think maybe number 8's similar. I think there's a couple like that. So anyway, as always, if you get stuck, have questions, have issues with Connect, anything like that, just give me a call, and I'll be glad to help